I've been investing on my own for over 10 years now, so I definitely put in the time, put in my 10,000 hours, learned a lot of lessons, made some mistakes in the last 10 years. So, if you're newer to investing, if you just recently started investing on your own in 2023, I'm going to go over 20 tips and I'm going to do them rapid fire, everyone. So, some of them are going to require for you to do your own research afterwards, but I'm going to give you 20 tips that I wish somebody told me when I first started, which in my opinion, I think is really going to save you a lot of time, a lot of energy, and it's really going to give you a good head start in case you're new to investing, brand new to it, or you're a beginner investor, you just started. And it could be some good reminders in case you have some experience under your belt. So here are 20 tips that all new investors should consider before they get started. Let's get started. All right, so tip number one, first consideration before you actually start investing is you should pay off your debt first. Very important, everyone. Of course, we'll exclude the mortgage here, but if you have credit card debt, loans, any sort of debt, you should pay that off first before you start dabbling in investing your money on the stock market. Very important. As soon as you pay off the debt or you're making a payment towards a loan that has interest, like a credit card or a car loan, you're literally making whatever your interest rate is, you're making that return instantly. So it's very important. Pay off your debt first before you even get started with investing. Tip number two, you have to understand what the stock market actually is. Okay, it could be a very scary place when you start reading up on it, and a lot of people are just scared of it. The stock market is just a market where shares or ownership percentages of publicly traded companies and funds as well, and ETFs are traded or bought and sold every day. So it's not an abstract, crazy thing. You need to understand what the stock market is before you start investing. You could go on YouTube and check out, there's many great videos. Just Google what is the stock market. Netflix has a really good, I think it's like 20-minute episode. So make sure you understand what the stock market actually is before you get started. Point number three, or tip number three, understand the difference between investing and speculating. I wish somebody told me this at the beginning. So if you're just going on Reddit and there's a hot new startup stock that everyone's buying because it could shoot to the moon, that is not investing, okay? In my opinion, that is speculating. Investing is you're buying and holding for the long term. Investing is more long term. It's a quality asset as well. So, a big reputable company that has a dividend, for example, that's more of an investment. A speculative stock is maybe something like a Tesla, right? That doesn't have a dividend. It only recently started making profit. It has a lot of volatility. That's more like gambling. Speculating is pretty much gambling. Investing, you're more buying quality for the long term. So very important. Understand the difference between the two, because most people, they start buying random stocks and they're actually speculating, they're not investing. Tip number four is really to understand, you have to understand the different investing accounts. So in Canada, we have the most important accounts that you need to understand are the tax-free savings account, the RRSP, those are the registered accounts, and then you also have a non-registered or account, which is simply referred to the cash account. So you gotta, there's more accounts than that, but those are the three basic ones. You have to understand how each of them work first, because you gotta know which one you're gonna start with. Typically in Canada, you're gonna start with your TFSA. So you got to understand the tax implications and all that, understand how these accounts work. Same thing on the US side, right? You got your Roth IRA, you got your 401k. You got to understand how these accounts work. So make sure to do your research so you really understand that before you get started. Next one is understanding tax implications. Number 5, right? So pretty similar to understanding the accounts. You got to understand the tax implications for your investment. So each investing account has a different tax implications, and same thing with type of stocks you have. You got to understand the difference between interest and dividend, capital gains, return of capital. Those are the 4 main income streams or income sources in Canada. The US has their own system. They have like short-term capital gains, long-term capital gains, dividends, interest, etc. So you got to learn the tax implications for investing. Number 6 is educate yourself on the 3 main investing strategies. So in my opinion, there's really 3 investing strategies. There's growth strategy, there's the dividend focused strategy, and then there's the income focused strategy. So all three work well long term. All of them have advantages and disadvantages. So it's very important you understand the difference between the three. I have a video that actually compares all three strategies, but it's very important you understand the differences. Tip number 7 is you got to understand that our economic system, how it works. It's a boom and bust system. So a lot of people get scared or they get worried that the stock market will crash and then it will never recover. If you actually look at it long term, it always recovers and goes up over time. It might have a really, really bad year like in 2020 or 2022, but you always got to think of it long term, right? So understand that our system is really a boom and bust cycle. It's nothing to be afraid of. It's just how it is. So once you understand that, you'll remove a lot of the fear that or negative connotations around the stock market. Tip number 8 is to think long term, not short term. Very, very important. Everyone's always looking for that quick buck. When it comes to investing, not speculating, investing, you got to have a long-term mindset. So if you do, you'll be much, much better off. Think long-term, not short-term. You're in it for the long haul, right? Tip number 9, don't watch the news. So at the beginning, I would watch, BNN and MSNBC, CN, whatever it is, very often, and they would predict and have experts on. And after 10 years, watching it now, it's almost comical to me. Don't watch the news. It's completely useless. They're just predictions. And if you don't believe me, don't watch the news for 6 months and see what happens, or a year, better yet. Don't watch it for a year, see what happens. You'll see that it's not going to help you in terms of investing at all. I'm not talking about, looking at YouTube and how-tos and information. I'm talking about the news where people just fear-mongering and doing predictions. You're barely going to learn. It's just going to confuse you even more. Don't watch the news. Number 10, investing is subjective. Okay, the best does not exist. I hear this all the time. What's the best ETF? What's the best stock? What's the best fund? Investing is something that's very, very subjective. It's like asking someone, what's the best food, or what's your favorite way to stay in shape? Everyone has a different preference. Investing is that way, guys. So it's very important to realize this, because the key is figuring out what's best for you, opposed to figuring out what the best is. The best doesn't exist. So remembering that, and right off the bat, trying to figure out what's the best investing style for you could save you a lot of time and energy. Tip number 11, investing in single stocks or single companies is riskier and is completely unnecessary. This will save you a lot of heartache, everyone. So I'm not saying it's a bad thing to invest in single companies. I'm just saying that if you're especially a beginner, it's really unnecessary. Now you pretty much have ETFs and funds for whatever your investing style is. Whether you want to be a growth investor, a dividend investor, an income investor, you no longer need to invest in single stocks. By doing so, you have a single point of failure. No matter how amazing the company might seem, if something happens with that company, things could go very bad for you. So in my opinion, it's always best to invest in ETFs that are diversified, that have many stocks. Investing in single stocks, everyone, is unnecessary, especially now in 2023 where we have so many great ETF options. Tip number 12, fixed income or bonds is probably unnecessary for most people. So I know I'm going to get some flack for this, but it's just the truth. If you're a long-term investor, I suggest pretty much going all equity. You don't need any fixed income or bonds. If you're going to invest money for 5-10 years plus, right? You hear that 60-40 split, 60% stocks, 40% bonds. The truth of the matter is fixed income always underperforms stocks or equities long term. So you absolutely don't need it. If you're in a specific situation where maybe you're older, you have a very short time horizon, you hate volatility, and you're okay with getting less returns for more stable or less returns but more stable returns, that's fine. But for most people, especially young people, long-term investors, my opinion, your fixed income is not necessary at all. Even if you want something lower risk than equities, there's equity style options that have lower risk. like the income stuff, like a covered call ETF, for example, which I'm not going to get into now, but that's definitely tip number 11. Tip number 12. Fixed income, not necessary in my opinion. Tip number 13, when you're doing research on particular funds or particular stocks, go on their official website. Don't do your research on Yahoo or Motley Fool or Seeking Alpha. Those are just opinion pieces, CNBC, BNN. If you want the official information, go on Vanguard's site, go on BMO's site, go on Harvest ETF's website and look at the fact sheets, look at what the fund has there. Always do your research on the fund's official website because by law, they have to provide that information. Number 14, tip number 14. This is especially true for if you're Canadian. The US market typically always beats the overall Canadian market historically. Okay, so a very common mistake that Canadians do is they only invest in Canadian stocks or only focus on the Canadian stock market. Huge mistake. The US stock market is king. The best stock market in the world, has the best returns historically over time. So just remember that. I'm not saying don't buy Canadian stocks. I own Canadian stocks and funds as well. But investing in US companies or in the US stock market will probably give you better returns over time than only investing in Canadian stocks. And I don't mean you don't have to invest in US listed stocks. You can invest in Canadian listed ETFs, so you get them in Canadian currency that have US stocks, right? So that's very important to understand that. Number 15, this is a good one. You need to understand stock price return versus total return. Completely different. Newer investors, I see this all the time, even with intermediate investors, is all they look at is the stock chart. Looking at the stock chart for any stock or fund that gives out income, gives out a dividend or consistent income, is completely useless because the stock chart just shows the stock price return, not the total return. You got to look at the fund's total return. Sometimes it's referred to as performance. Most of the time, you can find that all the time on the fund's official website to get the total return. Means it's as if you're reinvesting the income. It's counting the income if a stock gives out a dividend. So if a stock gives a dividend or whatsoever, there's no point looking at the stock chart, guys. It's completely useless and only tells you half the story or even less than half the story. You got to look at the total return. I'll give you a perfect example. If a stock is $10 and after 1 year it doesn't go up, it stays at $10, but it gives a dividend, a 10% yield dividend, so $1 per year in income, you're not going to see that dollar in the stock chart. You're going to see $10 and then after a year went to $10. You might think that's a bad investment. You don't make any money. The stock chart does not include that dollar that it gave you throughout the year. So it's actually $10. If you count the income, it's $11, right? Although the stock price didn't change. So you got to make sure to look at total return, not the stock price return or the stock chart. If a fund or a stock like a Tesla or an Amazon or a Google or a Facebook, a Meta, does not give a dividend whatsoever, then you could just look at the stock chart because the stock price return is all there is. The total return is the stock price return because that stock does not give a dividend. So for Amazon, look at the stock all you want. It's accurate. It will give you a good indication of what the fund's or the stock's performance is. But if fund gives a dividend or an income whatsoever, there's no point looking at the stock chart. You got to look at the total return. Tip number 16, which broker you choose is actually the least important decision. So I see this all the time with new people. They rack their brain. Should I go with Wealthsimple? I'm talking about Canada here. Wealthsimple or Questrade? Should I go with TD? Should I stick with my bank? So they spend so much time trying to figure out which is the best broker. I'm not saying it's not an important decision and you just choose a random one. That's not what I'm saying. But it's a least important decision you make because there's so many of them out there that pricing is very, very competitive, a lot more competitive than it was 10 years ago. So you're buying publicly listed funds and stocks, everyone, no matter which broker you choose, it's going to be the same thing pretty much. So yes, you got to research the brokers and see which is better for your goals and how often you're going to invest. But typically I feel people spend way too much time on this. So, I use Questrade. If you already do banking with TD, you could go with TD Bank. If you're planning on buying small purchases every month more often, I would suggest a discount broker like Wealthsimple or Questrade. If you're just going to invest once a month, $5,000 a shot, you could go with a bank broker if you already do your banking with them. It's very convenient. So don't spend too much time on choosing what broker. There's much better places to spend your time on, like actually researching funds and things like that. Tip number 17, don't obsess on management fees. Focus on total returns instead. So a lot of people are obsessed with management fees. They're just looking for the smallest management fee. And that's okay, but total returns includes or is net of management fees. So what I'm saying is that if two funds have the same total return, one of them has a management fee of 0.02 and the other one has a management fee of 2%, and they have the same total return, it's the same exact performance. The management fee doesn't really matter, right? It's really the total performance that matters. If you're going to compare an S&P 500 ETF from BMO compared to Vanguard compared to BlackRock, if it's the exact same thing, an S&P 500, then you could compare the management fees, but most likely they will have the exact same one because they're in competition, right? It's very rare you'll see one that has a smaller management fee. Maybe, Vanguard is known for the smallest fees, but always, don't obsess too much on the management fees. Obsess on the total returns. That's a much better obsession. Number 18, don't obsess on what everyone else is doing. So this is typical when you're new to investing. It's like when you're new to the gym and you walk in the gym, you're looking at what everyone else is doing. What you should be focusing on is figuring out the best investing style for you. Learn from people, see what they're doing, but you don't need to copy them. And you don't have to you could do a hybrid approach, right? You could be a half growth investor, half dividend investor, or 25% growth, 25% dividend, 50% income. Investing is subjective, like we discussed in the earlier point. So figure out what's best for you. Don't obsess what everyone else is doing. Figure out what's best for you. Number 19, sector diversification is important for safety. So you probably heard this term, diversification, but then you might hear some very high level investors like Warren Buffett or Mark Cuban said this diversification is for idiots. Well, diversification basically will pretty much give you average returns. Okay, you're not going to beat the market if you're diversified. It doesn't exist. Diversification gives you average returns, but it gives you safety. So diversification means you're investing in all different types of sectors. Now, there is sector diversification. There's also regional diversification. So sector diversification means you're going to buy you want to be diversified in terms of sectors. You're going to have technology stocks, healthcare stocks, financial stocks, utility stocks, material stocks. There's 11 stock market sectors, consumer as well. So there is 11 stock market sectors. I would learn those by heart. Now, does it mean you have to have an equal or proportion amount in every sector? That's pretty much impossible. You can do it, but it's very, very hard. So the Canadian stock market, for example, is very heavy on financials, utilities, materials, and energy, right? Because that's more representative of the Canadian economy. The US is very heavy on technology and healthcare, right? So sector diversification is important. It adds a level of safety to and stability to your portfolio. Regional diversification, in my opinion, a bit less important. In my opinion, the best stocks, the best companies are in the US. If you want to add some Europe, some Australia, Japan, Far East, there's even emerging markets. It'll add even more diversification. In my opinion, sector diversification is more important, but understand what diversification is. There's sector diversification, regional diversification, then there's also asset diversification. So there's 4 classes of assets. There's equities, which is stocks. There's fixed income, which is things like bonds and preferred shares. Alternatives, which is things like real estate. And then there's cash, right? So you don't have to, I say go all equity. That's just what I do. But learn at least the asset diversification, the sectors, and the different regions. Very important before you get started. Something very good to learn. Last but not least, tip number 20, stop waiting for the right time. Start ASAP. The best time to invest is always the same time, as soon as possible. So this is keyword investing here. So a lot of people, they wait for the right time. No, the market's not doing well. I'm going to wait till the market goes back to normal. Makes no sense whatsoever, guys. It's actually the complete opposite. The better time to invest is when the market is down, right? So whenever I see people trying to predict or time, it's called timing the market. It's pretty much impossible to do. the best strategy is really to invest consistently over time. Very, very important. So save yourself a lot of brain power of when you're going to invest. I have 5,000. Should I wait? Should I wait another couple of months? Invest regularly over time is the best strategy. That's my opinion. So if you're scared of, you don't know what to buy first, I strongly suggest just start with a passive index fund, like an overall Canadian, like buying overall the whole Canadian stock market or the whole US stock market. So the US stock market is, S&P 500 would be the most popular way. So you could get an ETF that's an S&P 500 ETF. For Canada, there's other ones. So I actually have a video called Intro to Passive Index ETFs where I show and feature some Canadian or BMOs, very popular Canadian index ETF, which will get you the whole Canadian stock market, and BMO's passive index S&P 500 ETF, which is like buying the whole US economy. Very, very, very safe. It can never be wrong to invest in these long term because it's like you're buying the whole economy, all the best stocks in the region. So it's a very easy, mainstream, safe way to invest. So don't wait for the right time. If you're hesitant, just start with those passive index ETFs. There is no best time. The best time is right away and consistently over time. So I hope these 20 tips really helped you. These are what I suggest to go over, and you probably have to do some research on some of these, but if you review and go over these 20 tips and learn about the topics, it'll give you a really, really good head start, in my opinion. It'll save you a lot of time, a lot of energy, a lot of heartache, possibly you're doing a big mistake. So it's very important to understand these things before you start investing. Hey, don't go yet. I have some important reminders, including some more recent ones, and I'll try to keep it as brief as possible. And for everything that I'm about to discuss, the links and info are in the video description below. So first of all, if you didn't know yet, I do offer a one-on-one coaching session where you'll have a 1-hour Zoom call with me where you could ask me all the questions you want, and I'll help you and assist you best I can. Just remember that I am not a licensed or registered financial advisor or planner. So to book a session, go on my website, passiveincomeinvesting.ca, and right there on the homepage on the left hand side there is a small video. Watch that video to know how to book a one-on-one properly with yours truly. Also on my website you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once, and this is really a reference tool or a companion tool to help you build your own portfolio according to your needs and your objectives. It has lists of funds, it has sample portfolios for both Canadian investors and American investors, so make sure to check it out on my website. I actually created a video which shows the product from A to Z because I don't want you to spend money unless you know exactly what you're getting. So make sure to check that video out on my website, and don't take my word for how good it is. Check out the reviews. There's over 300 of them and they are all 100% real reviews. So here's some more updated news or recent news. I am now on Blossom, a new investing app designed for investors. I've been using it for a few weeks now. I think it's really, really great. It has a really cool feature where users could actually add and share their portfolios and what they're buying and selling every day. So you could actually link your investing account so it's updated automatically on a daily basis. I recently added my own main portfolio so you could follow how my portfolio is doing live and what I buy every month. Really, really cool. It's like a mix of Facebook and Twitter, but specifically for investing. So get on your phone, click on the link in the video description below and download the app. It's 100% free, so you too could share your portfolio. Just remember to look for me and follow me. My username is Adrian, PII altogether. Also, I do have a referral link for Questrade, so you could get $50 worth of free stock purchases. This is the Canadian discount broker that I use and I recommend. Unlike Wealthsimple, the other popular discount broker in Canada, you could drip everything you want. It has all the stocks and it also has dual currency accounts. Very, very convenient if you're buying both Canadian stocks and American stocks. I have a Questrade video, by the way, which gives you a little tour of the features, so make sure to check that out. I also have a referral link for PASSIV. This is the portfolio tracking tool that I use to consolidate all our accounts to get a nice bird's eye view, so you can consolidate all the information together for easy tracking and stats as well. Also, our Facebook group, Passive Income Investing is now an invite-only private group. So to join it, you need to click on the link in the video description below and give the group a like to get invited. So we take pride in making this one of the best investing Facebook groups out there with over 13,000 members. There's no scams, there's no spammers, and negative and doomsday people, we kick them out right away. Also, follow us on Instagram if you want a little bit more of our personal journey here in Panama. And lastly, just remember everyone, I am not a licensed or registered financial advisor. This channel is all about my personal investing journey and how I invest to generate high passive income from a diversified portfolio of high yield funds. It's for educational purposes only, so don't forget to do your own research and due diligence. And of course, stay safe everyone, stay healthy, and of course, stay passive. See you next time.